We started discussing chapter 4 last week, and we had some discussion regarding the put and the call option, the basic put and call option. And the plan is to understand the other varieties which are available in the market. So, is there anyone who is not clear about the option contract? Is the option contract clear? Can one of you respond?
Yes, sir.
Yeah. So I am audible. So is the option contract clear? So if there is anyone who is not clear about the option contract, please ask. We are going to build on that. All right. So I guess it's all okay. So as I said, just a quick recap. We have two kinds of arrangements. One is the European arrangement where you only get to exercise your right on the expiry date. There is a chat. So you only get to exercise it on the expiry date for an European option, but for an American option, you can exercise it whenever you want between the time when you buy the contract and the expiry date. So for the American option, your exercise window is longer. So it is any time tau between small t when you are buying from up to capital T. So the pricing will also be differently done because the maximization will have to happen over the whole range of the timeline. So with that differentiation, I will now discuss some of the common contracts. We started discussing some of these uh, last day, but let me take it from the top again and begin from here. So this is where we discussed the call and the put option in long and short position together. So this was the simple European call and put option. So now we want to move on and talk about other varieties, at least some of the other varieties. So there are many of them actually, depending on the market, depending on the uh, underlying asset. The underlying asset could be stock, it could be commodity, it could be energy, lot of things. Depending on both of these things, there are various different contractual arrangements that are now available in the financial markets. Some of these terminologies may not be clear to you. I will try to talk you through that, but some of these things we will have to come back again when we have already learned the pricing models and their calculations. So the first item that we are discussing is called packages. Packages are, so you have already handled portfolio of stocks, but if you now consider portfolio of some standard options, say two European call options with different strike price. So two European call options on the same underlying asset, but the strike prices are different. So a combination of these two things would be called a package. And these packages are typically used to manage various types of uncertainty. So you may want to go long on a put option with a higher strike price and go short on, on a put option with a lower strike price. So all sorts of combinations involving put options with different strike or one call, one put, all of these combinations are possible. And the idea is to understand what is the corresponding payoff structure. The payoff structure is your final objective. So basically you want a certain kind of payoff structure, then you work backwards to realize that payoff structure using a combination of options. So standard examples which are very common in the financial market are called bull spreads, bear spreads, straddles, things like that. Okay. So these are essentially combination of European calls and puts at different strike prices, so that if you have a positive expectation about the market, you will acquire one kind of combination. These are called bull spreads. If you are pessimistic about the market, then you may want to acquire a bear spread, which is essentially going to insure you against the reduction in stock price, etc. Very often, we select our components of the package in such a way that the total cost is zero. So, considering the long and short, the total cost of setting it up is zero. But that is not necessary. And also, you can handle packages which consists of forward contracts. Remember, forward contracts are contracts which are going to be transacted in the future for sure. So options are contracts which may be transacted in the future. You have the right to use it, but you may not. A forward contract is an obligation, so you must use it. So both parties must be closing that contract on the designated day. So these are again combinations on which details we are not discussing right now, but we'll come back. But just to give you a flavor, if I look at the simple call and put option like this here, and if you use the two things together, so you use a call option and a put option, then you can very easily see that the payoff can can take a V or an inverted V shape. So this V and inverted V are very easy to construct using a combination of a call and put in long and short positions sometimes. And these are the basic constituents. These are like the basis of all the packages that one can think of. Maybe using more than two and at different strike price. Any questions here? Because I'm not talking about the details of the packages, because that's going to take a long time. But the basic idea is there combinations of different options, standard options. Okay. So the next item that I want to talk about is perpetual American options. A perpetual American option is which does not have a fixed expiry date. So it is like a fast passage time. Remember that I asked you to read up on fast passage time and the maximum distributions. Those will be required when we are going to price options like this. So it's an American option, so you can exercise anytime you want, but the payment will be given by a quantity Q when the stock price hits a barrier H for the first time. So when the stock price hits the barrier for the first time, that's when you will get a payoff. So it is called a perpetual American option because the expiry date is not fixed. It is stochastic. And then the details are here for the pricing, but we will not get into that because it will require the continuous time modeling strategy that we are going to discuss later on. So we'll come back here. But it is good to understand that options need not have a fixed timeline, fixed expiry date. So perpetual American options, for example, take a call option with a strike price K. This will be exercised when the stock price hits H. So the value will be H minus K, because when the stock price hits H, that's the stock price value, and K is the strike price, times this factor, which you can find out from the perpetual conditions. So if I want to maximize the value of this perpetual American option, you can simply choose H. so that this is maximized, and then the value of that perpetual call will be given by this expression. Here, this part s by h power alpha 1 is as of now assumed, which we will talk about later. But given that this is the value of a perpetual call, and similarly, a perpetual put can be priced also. There are other non-standard American options. One very popular one is called a Bermudan option. A Bermuda option is where the option cannot be exercised throughout. So typical American option can be exercised anytime between now and expiry date, capital T. For a Bermudan option, there is a restriction. It can be exercised only on some specific dates. So there is a discrete set of exercise dates for the option. So those are called Bermudan options. You can also think of an option where the exercise period does not start immediately, but it has an initial lockout period, and then the exercise can happen. So even if you buy it now, you may have to wait 7 days. That's the initial lockout period, and then only you can exercise it. So those are also possible. It is also possible that the strike price can change over the lifetime of the contract. Such contracts are called warrants or convertible options, and sometimes these arrangements are used for employee stock options also. Okay, another option contract is gap option. Gap option, if you think of the call, it will pay you the stock price minus K1 if the stock price is above K2. So K2 is the strike price and the put is exactly the other way around. So basically there is a gap between the payoff cutoff and the strike price. So K1 is with respect to the price which with respect to that price around which the valuation is done. So for valuation we are using K1, but for the strike condition we are using K2. So these are called gap options. Gap options can be priced in a similar strategy as for usual options. So when we learn about doing the usual Black-Scholes model, we can easily figure out how the gap option should be priced. Forward start option is like an initial lockout. So the option starts at a future time. And as I said, these are usually the contractual arrangements for employee stock options. The employee stock options typically kick off after a few years of service. So you are entitled to stocks, but you don't get them immediately. You will get them only if you give a number of years of service. But the price at which you get the stock may be much lower than the price at that time. So these are often structured so the strike price will equal the price at that future time in expected terms. So those are valued accordingly. Click options. Click options are rollover contracts. What is rollover contract? Suppose you set up a series of call options. A series of call options where the first one is completely known. The second one, the strike price is determined from the first one, and so on. And they might span a long period of time. For example, a click like this with 23-month options will span 5 years. So if you have very long-term planning and the market only allows you to buy 3-month long options, which is true for the Indian context, then you may want to set up a rolling over arrangement so that your uncertainty is managed for a long time in the future. You can either do it online, like once one option expires, you can immediately get into another arrangement and keep doing that, or you can plan for a long term by this click. Okay, so again, any questions at this stage? Because I have talked about quite a few option contract arrangements. Any questions or clarifications?
So do we have to remember all of them?
Of course not. What you need to remember is the basic principles, so that if I ask you that, okay, this is the option contract in the exam, I mean, you can find the price for it. So it is not a test of memory. It is a test of being able to apply the pricing models. Okay?
Okay, sir.
Yeah. So basically, there are hundreds of such contracts. I am only talking about a few of them, not because I want you to remember them. Remembering is not necessary, is not the objective. But I want to show you the range of alternative kinds of arrangements that are possible. You see, financial market is a place for people who has you know who has some imaginative power. So whatever you can imagine, actually you can design a corresponding financial contract. So and your imagination can span across commodities, across timeline, across currencies. It doesn't matter. If you can write it down, that contract is possible. So the objective of talking through this kind of different option arrangements is just to give you a flavor of the extent of imagination that people already have used in this market. Okay, so click options are those rollover kind of arrangements. In general, you can also think of something called a option on option. These are called compound options, which is you can write a call option contract on a call option. So usually a call option is written on a stock or some other commodity, some asset. But if your underlying asset is again a call option and you write another call option on that, so it's the function of a function. So those are called compound options. Compound options are typically priced very low because their probability of exercise becomes lower, but they can be valued analytically just by a repeated argument of the same modeling strategy. Sorry, chooser option. Chooser option is, again, it's like an implicit package, but it works in a slightly different way. The way it works is, initially you buy an option, you don't say whether it's a call or a put. You don't commit to that. So you start the option contract at time 0, which will mature at some time point t2, but somewhere in between at t1, I can tell the stock exchange whether I want a put option or a call option. So when I buy the option, I do not commit myself. I have the right to choose. And I have to choose at T1 whether I want a call option or a put option. So I have this interim time from 0 to T1 to gather more information and decide which type of option is preferable for me. And this is, if you can think about it, it's actually a package. It's like a combination. It's a combination. Why? Because you see, when you are choosing at time t1, you are basically going to take the one which has higher value for you. So your value for the contract will be maximum of the call and the put. And this is a result we will discuss very shortly, that the call and the put prices are exactly related for European type options. We will discuss this very shortly. So then I know that with that equation, I can find the actual value of the chooser option. So the chooser option can be actually valued, and the expression that will come is essentially like this. So it will be the call value plus something. So this is like a call at time t2, which is this C, plus this position in a put, because you see K it comes with a plus sign. So this is like a put contract, but this put contract is expiring earlier at time t1. So initially I have both the choices, but one of them will expire earlier. Because there is this put call parity, I can also write this in the reverse way. I can also write it in terms of the put which is maturing later at time t2 and a call which will mature earlier with relevant adjustments so that the parity is kept. Is this clear? This chooser option idea?
Yes, sir.
Yeah. So I think this is a good time to talk about the put call parity. Put call parity is a very important result. So let us understand put call parity because we are already talking about it, and then we will go back to the packages.
Sir,
Right. Yes.
sir, who has created all these types of options?
A lot of crazy people like us who are learning quantitative finance.
So can I create my own type of option?
Yes, you can. Actually, you can. You see, many of the bigger financial houses create new kinds of contractual arrangements every month or maybe every quarter. But of course, they have to be approved by the stock exchange. So, whatever you can think of, if you can write down the corresponding analytical pricing formula or numerical pricing formula, it's a candidate. But the candidate has to be approved by the stock market. The stock exchange authorities must check and make sure that this is not going to create any kind of instability in the market. But barring that, you can design anything that your clients may like and you can make a new contract of your own. In real life, what actually happens more often is some clients come to you, some clients come to your company asking for a particular type of financial arrangement which is not available in the market already or which cannot be directly constructed from a package combination. You have certain things already in the market, so if creating a package you can create your payoff profile that you want, then you are done, then you don't need to create anything new really. Any package is fine. But if there is a very specific requirement and you do not have a constituent contractual arrangement in the market already, then that's when the companies design a new contract and then they put it up for approval. I can just give you a quick example. If you visit the Multi Commodities Exchange, MCX, let me, it's a digression, but I think it's fine. So let me go to MCX. So MCX has a commodity index. Just like the stock market has a Nifty index of stock prices, MCX has a commodity index. That commodity index is traded just like the Nifty or the Sensex. Recently, what MCX has done is they have now started forward trading on the commodity indices. So this is the commodity index, commodity composite, commodity bullion, commodity base metal. Can you see the screen?
Yes, sir.
Yeah. So these indices were available in the market for some time now. These are again combination of commodity prices, just like the Nifty is a combination of 50 stock prices. These are also combination of commodity prices. The composite will have everything. The bullion will have only the precious metals like silver, gold. Gold and silver can also be available separately and so on. But recently, in fact, only last month, MCX has started trading on derivative contracts written on these commodity indices. Let me see if I can show it to you here. Probably not. Yeah. So if the page is opening. So this is the new derivative contract I was talking about. So MCX has started a futures contract on the commodity index on bullions. Bullions are precious metals. So gold and silver. Bullion are essentially gold and silver. So this has started only in August. So last month. So this is how the market develops. So you have certain commodities assets available for trading. Then you want to write derivative contracts on them. And once you write simple derivative contracts like futures and options, then there is a requirement for more complicated contracts. And slowly those complicated contracts come into existence. This has come into existence on August 24th here. Trading has started. And of course, in a few years' time, other kind of derivative contracts on these will come into existence. Okay, is this clear?
Yes, sir.
Yeah. So this is how things happen. So when you are working in the financial sector, if you go to a financial company like that who design such products, this is what you will be doing, or at least take part in doing. Okay, so put call parity, a very important result in financial pricing. So I have two European option contracts, put and call. So think of a put and a call option with the same stock and the same strike price and the same timeline. So it starts today at time 0 and expires at a fixed time. So initially we just think of the one period model as in our chapter 1, and we say that the option starts today. You can buy the option today and tomorrow it expires. So you can exercise it tomorrow if you want. Of course, exercise is not mandatory. You will do it only if it is profitable for you. So suppose I have a portfolio today which has the put contract and the underlying 1 unit of the underlying stock. So that portfolio today will be priced at P plus S naught, because P is the price of the put contract and S naught is the current stock price. So that is the value of my portfolio now. Okay?
Sir,
Yes.
are we here considering only one stock?
We are considering a put and a call option on the same stock, a single stock,
Okay.
and these options are 1 period lived, so they will expire tomorrow.
Okay.
Is that clear, or did you?
Yes, sir. Yes, sir.
And the is same strike price, same K, same strike price. So if I have the put contract and the stock in my hand as my portfolio, then this is the yes. Did somebody ask something? Was there a question? No. Okay. Then the value of this portfolio is P plus S naught today. Now, if on the other hand, I have the call option with me and this amount of cash, K by 1 plus R amount of cash, then the value of that portfolio will be C plus K by 1 plus R. So these are two alternative portfolios we are considering, we are trying to evaluate what happens to them. Now, tomorrow, when S1 is realized, the stock price tomorrow is S1 is realized, one of two things will happen. Either it is more than K or it is less than K. I will include the equality case in the more than thing. It doesn't matter because it will not make any difference to the calculations. Now, if the stock price is more than K, then what will happen? I will not use my put option, but I will use my call option. That's the logic. So the put option becomes worthless, it expires, I have the stock already with me. So now the stock price is S1. So the value of my put plus stock portfolio is now S1. If you think of the other portfolio, call plus cash, what will happen now? In one period, this money K by 1 plus R will become exactly K, because it is in the bank and it will grow. So it will become K. So at T equal to 1, because stock price is more than K, I will use my call option, and using K amount of money, I will get the stock. So the value of my portfolio will be S1. Is this clear to all of you?
Yes, sir.
And
Can you repeat this part again?
yes.
Can you repeat this part again?
So if I have a put contract and the stock price is more than strike price tomorrow, the put contract is not going to be used, so it will expire worthless. But
Yeah.
I already have the stock, so the stock has now become S1 valued. So the
Yes.
value of my portfolio becomes S1. That part is fine, isn't it?
Yeah, yeah.
Yeah. The call I will be using in case S1 is more than K, because it is profitable for me to use. So what will I do? I will use the cash, because the cash has now become K, exactly as much as I need. I pay that cash to the stock market, get the stock. So the value of my portfolio is S1 again, because the actual value of the stock now is S1.
Yeah.
Yeah.
Yeah, yeah.
Now look at the other case. When the stock price is less than K. Exactly similarly, you will now see that the put option will be used, but the call option will not be used. And using the put option, I will get K amount of cash, and when the call option expires, I am left with K amount of cash. So again, in both cases, for both these portfolios, my value of the portfolio will be K. Again, is this clear?
Yes, sir.
So then these two portfolios have identical payoff tomorrow. See, we have covered all cases. All S1 greater than equal to K and all S1 less than K. That means I have covered all possible stock values, stock prices tomorrow. The whole range. And in the whole range, I can see that these two portfolios have the same value. Clear?
So do we start with the same price at T equal to 0?
Same price for what?
The same portfolio value?
Yeah, that is the conclusion. That is the conclusion. That's the next line here. Law of one price will force the value at date 0 to be also the same. If your contracts have the same payoff tomorrow, remember law of one price, I have two portfolios with identical payoffs tomorrow, then they must have the same value today. So that is exactly what we are trying to show. We have shown that tomorrow they have the same value in all situations. That means today their value must also be equal. That is law of one price. And that gives me this equality. This equality is actually known as the put call parity. And it is very easy. You can just do it at home. That even if you have a multi-period situation, it won't matter. You will still have the same parity relation. Only this 1 plus r will become some power of 1 plus r. Number of periods, the power will be the number of periods. So that means for European options, the put price and the call price are exactly related to each other. So all you need to do is find out one of them directly. So is this result clear to all of you? This is a very simple result, but a very important one. So silence means what? Silence means it's clear. Or what is the default?
So does this actually happen?
Does what?
This equality? I mean, are the put and call prices decided so that this equality holds?
Okay, suppose it does not hold. Suppose it does not hold. Can you get a free lunch out of the market then?
Yes, sir.
So it has to hold.
Yeah.
You see, if you want to check whether any result in the financial market is true or not, correct or not, the only thing you need to check is whether, if it is not true, can you make something out of nothing? Can you get a free lunch? If this equality does not hold, now you already know that you can get a free lunch out of this, which the market will not allow. So it will force this equality. All right. So this is the important result known as the put call parity. Remember that for American options, such a result need not be true, because in American option, the exercise range is multiple time periods, a whole range of time. So there, this put call parity can break down. But in European type of arrangements, put call parity will always hold. Okay. So now I will want to go back to my menu of contracts. So we have already talked about the chooser option, where we have used the put call parity explicitly. Now you can see that this is the version of put call parity for continuous time compounding. In the result that I just showed you, we were doing discrete compounding. We are dividing by 1 plus r or multiplying by 1 plus r for each period. If we think of a continuous compounding, because that will be relevant when we are in the continuous time scenario, then that formula will be replaced by this e to the power minus r t2 minus t1. So if I am compounding over this time interval, then I use the e to the power r times time interval formula. This you know, correct? The continuous time compounding version. This is just a limit of that discrete time process. Is this known to all of you? Again, what is the default? The default is clear, right? So should I assume that all of you are clear about it?
No, sir.
No, you are not clear about this?
No.
No. Okay. So in a discrete time setting, this is what happens. You have k by 1 plus r, correct? Or if you put money in the bank, it will grow at the rate of 1 plus r every period. So in t periods, your money will become 1 plus r power t times. Correct?
Yes, sir.
Now, this is dependent on applying the interest rate at the end of each period. So basically, I am applying the interest rate at the end of period 1, period 2, period 3, etc. That's why I get this multiplication form. If instead of that, I say that no, I want to apply this interest rate more often. So instead of after one period, I want to do it after half a period. So of course, what I will do is within a period, at the midpoint, I will apply r by 2, and again at the end, I will apply r by 2. So that the total is kept at r, the same level is kept. So I apply r by 2 in the halfway, R by 2 again at the end. So the formula now becomes 1 plus R by 2 whole square. Okay.
Okay, sir.
Now, can you extend this to more partitions of the time interval? So now instead of 2 partitions, I can think of n many partitions
Yeah.
and take the limit. What is going to happen?
Yeah. Okay, sir. Now I got it.
It's a standard thing. You must have done it in your first year or even in class 12. I think you have done it in class 12. It's a very straightforward result. So that version is what is being used here, the continuous time compounding, and using the put call parity with continuous time compounding, we can evaluate the chooser option as a package deal, either as a package deal of a call and a put option maturing early, or a put option plus a call option maturing early. Now you know how to go from one to the other, how you can switch between a put and a call. So that you can do very easily here. It will take a little bit of practice, but it is good to do these things, start doing these things now. Okay. A very important class of options are barrier options. So barrier options are very popular. When I describe them, it will become clear. Barrier options are options which are triggered on or triggered off when certain level of stock price is reached. So those levels are called barriers. So you can think of this into two possible scenarios. An option will switch on when you hit the barrier, or a option will die if you hit the barrier. So if you switch it on, then they are called in options, and if they die, they are called out options. So barrier options can be of the type of in or type of out. And also, I can think of the barrier below the current stock price or above the current stock price. So I can have a situation where the barrier will be hit from below. These are called up options. So the barrier is above you. So the barriers are up. Or you can hit the barrier from above, which means the barrier is below you. So those are called down barriers. So you can have up barriers or down barriers. So ceilings or floors. And the option could be a put option or a call option. Anything, right? So combine everything, you have actually two cube combinations. Put call, in, out, up, down. And this will, I think, clarify matters a lot. That if you are thinking of the relationship between all these 8 combinations, these relationships are very easy to figure out. That a standard call can be thought of as a up and in option and an up and out option, because one of them is alive at any point of time, and together they constitute the whole call option. Because if you have both the up and in and up and out, then together it's the whole set of possibilities. So it is just a call option. So a simple call option can be thought of as a sum of 2 barrier options, up and in, up and out. By the same logic, it can also be thought of as 2 down options, down in, down out. And if I can do that for call, I can also do that for put. So I also have the third and fourth relationships like here. And of course, I have put call parity for the call and put options. So there will be one more equality here, which will be the put call parity. So even though I have 8 combinations, they are not really independent of each other. There are 5 equations linking them. So barrier options, again, I'll just repeat, are options which comes into existence or dies when some barrier is hit. The barrier can be hit from below or above, and the option can be a put option or a call option. So with any type of option, I can write a corresponding barrier option, and the barrier options are related to each other. Their prices are related to each other through these relationships. Is this okay? Is this clear?
Yes, sir.
Okay, so again, so before I go into binary options, let me go back and check if I have something to talk about. No, I'm fine. Yeah. So we can continue this discussion here. So the next option are called binary options. Binary options are like cash or nothing. So we already discussed a similar kind of option earlier, which is, hold on, which is like the perpetual. With the perpetual also pays a fixed amount if there is a barrier is hit, but in a binary option, the strike is only one single strike, and if you cross the strike price, if you are above the strike, you get Q, otherwise you will get 0. So in a way, it's a special case of a standard call option, and the pricing can be done accordingly, either call or put variation, whichever. You can also think of a binary option which will give you the asset or nothing. So it can be either cash or nothing or asset or nothing. For asset or nothing, you will use the stock price. For cash or nothing, you will consider the fixed amount of cash that it promises. So binary options are important because if you look at this carefully, binary options create a basis for the whole option spectrum. If you think of the whole space of options, binary options acts like the basis set. Any option you can recreate using a combination of appropriate binary options. Is this statement meaningful? Can you understand the statement there that I just made? Okay, so again, I assume that it is clear. So I will just look at one or two more cases and then we'll take a break. So for a call option, we have already said that there are long positions and cash and short positions. So for a long position, you can think of it as a asset or nothing binary. For a short position, you can think of it as a cash or nothing binary. Because if you have a long position on a call, if you use it, you will get the asset. And if you are in the short position, if it is used, then you get cash. Is the reverse of the long situation. So as I just said, that binary options can be thought of as the basis set for the whole space of options. You can think of call options, long or short position, as a binary option situation and value them accordingly. Of course, we can value call options directly. We will learn how to do that. But binary options will give you an alternative way of valuing anything, any option. Another important class of options, look back. Look back options are where the strike price, the strike price, notional strike price, depends on the minimum or the maximum stock price that was observed during the life of the stock. So if I have a call and if my strike is the minimum stock price over this interval, then that is a look back option. And in the reverse case, for a put option, we will want to compare it with the maximum stock price during the life of the option. Why is it called look back? Because it is looking back on the history of the stock price before deciding what is your payoff. So you do not exactly know how your payoff will be calculated till the end. So you have to find out the corresponding distribution of the minimum and the maximum of the stock price. And that is why I asked you to study the maximum value distribution for a binomial model. If you can do the maximum, you can also do the minimum. It's the same thing. But is the look back option clear? Is the look back option clear?
Yes, sir.
Hello? Is the look back option clear to all of you?
Yes, sir.
Yeah, okay, thanks. So look back option also has a fixed variation. So this floating variation is the more popular one, but there is also a fixed variation where there is a strike price, and at the end of the day, what you compare is the maximum stock price with the strike price or the minimum stock price with the strike price. So there are two variations. One is where you are looking at the actual stock price at the end, and the other one is where you are fixing a strike price beforehand. But in both cases, your payoff will depend on the maximum or the minimum realized during the lifetime. So the value of this option depends on the whole stock price history, depends on the whole history. Fortunately, analytic valuation formula for this kind of options are now available. For a long time, these things were too complicated to find a formula for pricing. People used to do it numerically through simulations or numerical approximation. But in the last 20 years or so, many of these complicated options have been completely analytically solved. So you now have analytical formula for valuing this kind of options. Okay, so I will take a break here. And we will start at 12 o'clock again. Unless you want to ask me something, we'll take a break now.
Sir,
Yes.
can you give an example when a call on a put option or put on put has been like an example of it? Like I cannot think of any case. Why would someone like put a call option on a put option or like a put option on a put option?
Oh, why would I want it?
Yeah.
Oh, okay. Oh, that's easy. Think of a call option. The call option gives you the right to buy a stock at a pre-specified price.
Yes.
Okay. So think of a situation where I have an obligation to meet in a future date. At a future date, I have to supply somebody with some stocks.
Okay.
So what I will do today is, rather than waiting for that day and facing all the uncertainty, I will buy a call option today so that I can freeze the price. I will never have to pay more than K. So when my commitment time comes, when I have to fulfill my obligation, the maximum I need to pay is K. So it minimizes my risk. To minimize that risk, I pay some amount of money today. I buy the option. That is there is some price for it. But end of the day, it will save me from the price uncertainty. And it will be particularly important if I'm afraid that the price will go up, the stock price will go up.
Okay.
For a stock, this is not really so important, not really so natural. But if you think of a commodity situation, it will be easier to understand. Suppose you are an airline company and you are using a lot of fuel, aviation fuel. So then, if you are afraid of prices rising over the next month or next 2 months or 3 months, you will feel more comfortable if you buy call options on the fuel. So
Yes.
I guarantee myself a fixed price for the future. Okay.
Option, a normal call option. This is then like why would I do a put on it?
For exactly the reverse kind of scenario, that suppose I have some stocks and I have a cash obligation in the future. I have to pay some money to some person. So I make sure that I can always sell my stock at K or more. See, if my stock price goes down, then I may not be able to get whatever cash I needed. So with a put option, I will guarantee myself a price.
I think Prakhar is looking for an example of compound option, like put on call and call on put.
Okay. So you want a compound option situation.
Yes, sir.
Oh, I see. Sorry. I didn't probably didn't hear clearly. Okay. So suppose I am looking at a call option decision or buying the stock decision in future. Now the story is twofold. In future, I have to take a decision whether buying the call option would be good or buying the stock would be good. So to reduce my uncertainty, I can buy a call on call option today. Because if when I am going to buy the stock or the call, if their prices becomes high, then I have to pay more. But if I buy a call option on a call option today, then the future price of the call option becomes fixed. So it's a twofold story. In the end, I need the stock. Before that, at some point, I have to decide whether I should buy the call option or buy the stock outright. I can either buy the stock immediately, but that will actually reduce my cash holding. If I buy the stock, I have to commit more money to that. Or I can buy a call option. But even before that, if I am not sure which one I should be doing later, the call option, I can guarantee myself a price by buying a call on call. Is that what you wanted to understand?
Yeah, so basically I am having an option whether I should have that call option or whether should I directly go for the stock.
Essentially.
Okay.
It can be more complicated than that. You can think of a menu of call options. I don't know which one I should take. So I buy a call option on all these call options at different strike prices. On that appointed day, I will take the one which is most suitable to me. Because
but generally it must take like some amount to generate a call option, no? Like you must pay some fees or something.
Of course, you pay a fee, but I think we already mentioned that compound options are typically very cheap because their exercise probabilities are very small. Their prices are quite low. So rather than buying one call option, it might be cheaper to buy 10 call on call options. So you keep all your choices open, and on the appointed day, you take the one which is most suitable.
But like won't it form like a chain at the end? Matlab if at like the twofold call option is like less probable to happen, then a threefold would be even less probable. So won't people like keep on forming a big chain for it? Like
you can, of course you can. You see, we have already discussed a click option, right? A click option is like a rollover situation. So normally,
yes.
Normally you think of rollover situations as on a stock, but you can also think of rollover situations on call options. There is nothing to prevent you from doing so. You have to remember two things. One is that when is your obligation going to come? So that timeline you have to cover, that you may not be able to cover with one contract because one contract is typically 3 months life. The other thing that you have to remember is the obligation in the end, whether it is cash or it is a stock. So these two things together will tell you exactly what kind of option or compound option or package you have to set up. And you find the cheapest way to do it. there might be multiple such choices and you take the cheapest one.
Okay.
It is really complicated, not in the sense of being mathematically complicated. Mathematical formulations are not that difficult, but it's complicated because your business obligations can be very complicated. You have to think of long-term business perspective and work out what are the things that you need. Okay. Okay, all right. So let me take a break now and okay. So are there any questions regarding whatever we discussed this morning? So if there are no questions, then let me resume. So we stopped at the look back options. So let me talk about one or two more. So shout option is an option which you can terminate earlier than the usual expiry date. So the contract works out in the following way, that the buyer can shout once during the option's life. Okay. So from today till the expiry date, if any intermediate time, if you make a shout, then the option stops there and the final payoff is decided on that day. So final payoff is either the usual option payoff, which is the maximum of ST minus K and 0, or the intrinsic value at the time of shout. Whichever is more, you will get that. So, sorry, you get the total thing. So payoff is the maximum of this gap. You will get the maximum of these two things, which can be written as like this. So a maximum of ST minus S tau and 0, and of course S tau minus K. So this is like the maximum of these two things here. Okay. So a shout option is basically like an European with one early termination option. So with that early termination option, which is called a shout, you can terminate at any point of time. In that case, that time will, the stock price at that particular time will also be considered for your final payoff calculation. So your payoff calculation will not only depend on S capital T, it will also depend on when you have made the shout at some time tau. So it is of course not as general as the look back option, but it gives you one backward view, one point in the time interval, intermediate time point, where you can make the choice. So it is less choices than look back, but more choices than the usual option. So of course it is cheaper than a look back option. Another important class of options are Asian options. Asian options are also history dependent. It depends on the whole stock price history during the lifetime of the option. It in particular looks at the average stock price during the lifetime. So the payoff for this kind of options will be given by, for a call, it will be maximum of the average stock price minus K and 0, and for the put is the reverse. So instead of looking at the stock price at the end date, it looks at the average of the whole history. Okay. So is this clear? You can also use the average stock price as the strike price. So instead of K, you can use the average. And then the strike options, Asian strike options, will have a payoff of this form. So there are two variations. One is where instead of S capital T, you use the average stock price as the payoff determining stock price, or instead of the strike price, you use the average stock price. Both variations are available, And obviously you can see that they are very closely related to each other. So the pricing can be done analytically also. And if one of them can be priced, the other one can also be priced. So this is not exact analytical valuation. I'll tell you why. Because when you take the average of the stock prices, to find the distribution of that average is very difficult, the arithmetic average. But what we do is we assume log normality of the average. Again, remember, stock price is usually assumed to follow a log normal distribution in the continuous time. We will talk about that later, but in general, our primitive model is the returns or the log of the stock prices, they follow normal distribution. And if the returns follow normal distribution, then the stock price would be following the log normal distribution. And even though normal distribution is closed under arithmetic averaging, log normal is not closed under arithmetic averaging. But to handle the Asian option, we keep that assumption that even the arithmetic average is also log normally distributed, and then we do the analytical valuation. That's why it is not exact, but it's approximate. The approximation is in the distributional assumption. So is this clear? So Asian option depends on the average stock price, and the pricing is not exact, but comes with an approximation through log normality assumption. Is it okay? All right, so let me move on to the next one, which is called an exchange option. So an exchange option actually involves two assets. What I can do through this exchange option is I can exchange one asset for another. So if I exchange one unit of asset U for another unit of asset V, then the payoff will be maximum of V minus U and 0. So it is like exchange. So a usual option is exchanging one unit of an asset with cash. Here it goes one step further. You are exchanging one unit of an asset with one unit of another asset. So here, instead of payoff being in terms of the stock price and cash, we have the payoff in terms of the two stock prices. So exchange option is where the numerator, instead of being cash, is also another stock or another financial asset. Basket options are again like packages. So you can buy or sell a portfolio of assets using an option. And in a basket option, because we are using a linear combination of different asset prices, again the log normality assumption is approximate. So what we do is we do a approximation through assuming that, and we calculate the first two moments of the value of the basket. So it's the same problem as the Asian option, because the exact log normality is no longer true, but we make that assumption to find out analytical expression for the price. All right. So these are options. I will finish the discussion with something called a swap. Swap is another very important financial arrangement. So far, we have talked about a lot of arrangements. We have talked about options and combinations on them. We have talked about forward contracts, which are obligatory on both sides. Now, I will also talk about swap. So these are three major types of financial derivative contracts which are used in the market, and a lot of combinations of them, of course. Now we have very complicated combinations. So an important class of swap contracts are volatility swaps or variance swaps. What does it do? A volatility swap is an agreement to exchange the realized volatility between time 0 and t. So instead of looking at the stock price, I now look at the variance of the stock price. And again, of course, I do not like variance. I am a risk-averse individual. I like certainty. So I want to sell off my volatility I face. I want to sell off the volatility of my holding against a fixed volatility factor, a pre-specified fixed volatility, and this arrangement is called a swap. So I pay you some money to face my actual volatility. I don't want to face uncertainty, and I pay you some money. In return, I only face a fixed amount of volatility. So whatever the actual volatility may be, he will take care of that for me. I have paid you money for this, and I will only face a fixed volatility. Is this arrangement clear to all of you? Because this is a different kind of arrangement. This is working with the variance of the stock price, not with the actual stock price. Can you just tell me if this is clear?
Yes, sir.
So I am exchanging a stock with cash. That's the usual option arrangement. I can exchange a stock with another stock, or I can exchange a basket of stocks, and I can write more complicated contracts on these. These are the usual options that we understand. In the volatility swap situation, what we are actually looking at is exchanging variance values or volatility values. So a volatility swap is exchanging the realized volatility, and a variance swap is exchanging the realized variance rate. So both are similar swap contracts. So you get rid of the realized volatility, take a fixed amount of volatility. In return, you pay some money. And for all these calculations, we normally assume that the daily return is 0. So we assume that the mean is fixed at a level, and we try to manage the fluctuation either in terms of volatility or rate of variance rate. Empirically, these are slightly tricky because realized volatility estimates are not unique and they have different sampling properties. But in real life scenarios, this is a popular contract because for the main reason, people do not want to face future uncertainty. So I want to get rid of the volatility of whatever stock I am working with in future. How are they priced? So the risk neutral valuation principle again comes here. So I do the expected variance rate. So the expected variance rate is calculated through this kind of a formulation for a usual log normal stock price process, which we will figure out slowly. And then we use some approximations. These approximations may not be familiar to you unless you have done some asymptotics from the C.R. Rao book. How many of you till read the C.R. Rao book, Linear Statistical Inference? Anyone?
Sir, all of us have read it, I think.
Oh, very good. So why didn't you tell me that? So have you seen this expression somewhere there or something like this?
Sir, I don't at least recall such expression.
No, I understand that, but there are, you see, one section of C.R. Rao book is like one chapter in other books. So there, everything is written in a very short, very precise manner, but a lot of results are there. So if you look up the asymptotic distributions, there is, I think, some section in chapter 1 somewhere. So there you will find this kind of approximations. So these are called second order approximations. This is just like using the Taylor series up to the second term and then ignoring the higher order moments. So volatility swap calculation, even though the actual analytical expression looks like this, if you try to evaluate it fully, it will become very complicated. So what you do is basically use this kind of approximations. So don't worry, I'm going to arrange a special lecture on this, so you will get more details. But for now, it is important to understand that we have also financial arrangements which allows you to sell your volatility. So you can sell the volatility you face in return for a certain price. So these swaps can be priced. You pay the price and you get rid of the volatility. Okay. So any questions here? Because I have actually gone through quite a large menu, and the real menu is even bigger than this. But as I said, what I wanted to show you is not what are available in the market in its entirety, but rather to tell you what are the kinds of different arrangements that are possible, how complicated, how imaginative people can be in designing contracts to get rid of risk, get rid of uncertainty, or maybe maximizing profit. Okay, so this presentation is there in the Google Drive, so you can always get back to it, look at the details from Hull, because all these slides are from Hull's book, John Hull. And if there are questions later on, I will be happy to discuss. But of course, we have omitted all the analytical pricing details so far, which we will now take up slowly. We will take up slowly from the very simple setup of call options, European call options, and slowly build up to more complicated contracts. Where am I? Okay. So we were here. We were talking about different kinds of contracts, and we also discussed the put call parity in between, which is a very important result, and it's used quite often in financial asset pricing. Now, let us explicitly go to the binomial model. Okay. So now I think it's time we can explicitly go to the binomial model, where the risk neutral price is calculated using this expression. We have seen this last week. And our first task would be to look at European type and American type call options. Okay. So let us do that using some simple examples. A little bit of notation. An European type option contract is basically a random variable capital X, which is some function of the terminal stock price. Of course, it depends on the initial stock price, rate of interest, and the strike price. These are all inputs, but they are perfectly known when the contract is written. So this is basically dependent on the uncertainty and the terminal stock price. Instead, for an American type option contract, the price process, if I call it Y, that is dependent on the whole history of the stock price, because American type can be exercised anytime from time 0 up to time capital T. So it is more complicated. It uses many more variables. Let us denote the value of the European option at time T by capital VT. So at all intermediate time points, I can, in principle, find out the value of the European contract that I call VT, and corresponding American options value I call ZT. So V and Z will be dependent on this X and Y, of course, on Y basically, because X is already in Y. So our valuation of options will be through finding the values for ZT and VT. Is this clear? That VT and ZT are the two processes we are actually planning to evaluate. Is it clear to all of you?
Yes, sir.
Okay. So now let us go to the binomial tree. So this is an example from page 126 of Pliskar. So if you have the book in front of you, you can simply open it at page 126 and you will see this picture. I have written it out for my benefit, and because there were some clarifications that were needed to be put. So rather than showing you the book page, I am looking at a handwritten page. Unfortunately, the handwriting is not too bad, so you can all read it. You can, right? This is okay, right? The handwriting here?
Yes, sir. Yes.
Because this is my handwriting, and my handwriting is typically worse than any of my students. So I have to be careful. So this is figure 4.2 on page 126. This is an example for call options where the strike price is 5. The rate of interest is assumed to be 0, because for calculations, we can make life simpler by assuming the rate of interest to be 0. And there are 2 time periods. So we start at time 0, then there is an intermediate time 1, and the final time 2 where the options expire. Now, if I am interested in the European option, then all I need to do is look at period 2, because in period 1, I cannot do anything. But if I am looking at the American option, then I also need to evaluate period 1. And typically, all of these evaluation processes works backwards. So these are called backward induction type method, where you look at the last day first, because there is least uncertainty there, and work slowly backwards. Okay, so what is my setup? My risk neutral probability is given as, so this is calculated from the UR values, UR and D values, which are already done beforehand. In this book itself, in earlier examples, this is done. So I will not repeat that. Let me just take those values. The Q probabilities at the end, because I have 2 periods, there are 4 nodes at the end. So I need to specify the 4 terminal probabilities. They will of course depend on the branching probabilities here at the first node and here at the second node. But with this probability distribution 1/6, 1/12, 1/4, and half, we will start calculating from the last. Okay. So the stock price process evolves in the following way. We start with S0 equal to 5 at time 0. Then at time 1, it can either go up to 8 or go down to 4. From 8, if I have already taken one up step at 8, I can go further up to 9, or I can come down to 6. And if I have come down in the first step at 4, then I can go back to 6, or I can go further down to 3. So my possibilities are 9, 6, and 3. So 9 comes with probability 1/6, 3 comes with half, and 6, this middle nodes, 6 comes with 1/4 and 1/12, which is again 1/3. So this is the setup. This is the complete description of the stock price process, the binomial process. Now, what happens to the options? Remember that Y is the process for the American, and Y capital T is also for European. V is the value, and the condition that we are essentially interested in is the following: that if Vt, the value of the European, is greater than or equal to Yt, which is the value of the process, for all t for all omega, then for all t, Vt will be equal to Zt. You see, what happens with the American? The American is the best choice available at a particular point of time. So if the European option is as good as all the possible scenarios at all possible time points, then I cannot do any better than the European. So the value of the American will be same as European, which is saying that I will wait until capital T to exercise. So early exercise is not optimal, because the European value is always better than the current situation, or at least as good as the current situation. So is this clear? Is this logic clear? The relation
Yes,
between
sir.
the American and the European? Because even if it is better, strictly better at one of the nodes, I may plan to exercise the option earlier. So I must be having the situation where Vt is greater than or equal to Yt for all t for all omega. Then Vt equals Zt, and I will not exercise the American option earlier. Okay, so let us see what happens in this particular example. So in this particular example, as I said, when I am at stock price 9, of course my Y will be 4 because it is 9 minus 5. The value of the European option is of course 4 because it is going to expire. So I have to exercise if I want at that point. If I am at 6, Y2 is 1, V2 is also 1. If I am at 3, then you have to see that Y2 is 0, V2 is 0. Because it is less than 5, my option is worthless. So the last node is very easy to evaluate because all uncertainty have been realized. Now I have to fold back. If I fold back to day 1, now in the upper node in day 1, think of the stock price S1 equal to 8 case. What is the value of the European option now? See, European I cannot exercise now. So for me, the value of the European option is the expected value of what can happen tomorrow. So it is the combination of the top two boxes, either 4 or 1 with probabilities 1/6 and 1/12, which gives me a V1 equal to 3. So the value of the European option on day 1 for me is 3. I am not going to exercise it now, I cannot. But this is the expected payoff. What about the Y process? Because for American, I am open to exercising. For the Y process, I will directly look at 8 minus 5, which is again 3. So this is not better than V. So at this node, I do not gain by exercising the American option early. Similarly, if I look at the lower box here, where stock price is 4, my American option is not going to give me anything. It is 0 because it is less than 5. Instead, my European option expected value is 1/3 because tomorrow I may have a positive payoff of 1. So I actually strictly gain by holding on to the contract. And then I finally fold back to day 0. On day 0, the value of the European contract is again an average of this 3 and 1/3 as per the probabilities, which will come to 1. What about the value of the American? Y0 is actually exactly 0 because stock price is same as the strike price. So again, V is strictly better than Y. So if I look at this whole picture, I will see that V is everywhere at least as good as Y, which means Z will be equal to V. So American will be equal to European. So I do not gain by early exercise. So the price of the American call will be same as the European call. So is this clear? Is this clear to all of you? It's a simple two-period binomial model, absolutely simple, but I want you to understand the idea, the whole idea of calculation, because in a simple two-period, four-node model, the calculations are trivial. But when you are looking at real-life models with many nodes, the calculations become really, really complicated. In fact, if you remember that I showed you what I showed you earlier, the binomial option calculator. See, you remember this one. This is the real life option calculator where you can have a large number of steps also. So I was showing an example of having 10 steps. And in that case, these calculations will have to be done very carefully using actually a computer program. We will not do it manually. We will do it through a computer program. So you see, this is looking at an American option where the strike price is 29, underlying asset price starts at 30, and I have 40 days broken up into 10 steps. So if I do all these calculations from the terminal node here, I will end up with a price of 1.52. Of course, there is an interest rate here, so there is some change in these numbers. In my example, I assumed interest rate to be 0. So if I put 0 here, so it will change. It will become 1.455. So can you all see this?
Yes, sir.
Yeah. So you can just play around with this model. This is a very nice option calculator. Of course, it won't work for very complicated contracts, but for simple contracts, you can play around with this one and get some idea how these calculations happen and where the American will be actually more expensive than European. So I will show you one simple example here where American is actually better than the European. So there is an early exercise somewhere. So what is the scenario? The scenario is the following. Here, my stock prices evolve in the same way, with starting from 5 and going up to 8 and 4, etc., 9, 6, 6, 3. The probabilities, the Q probabilities are also same. But the difference here is that I have now chosen a strike price of 4, and I am going to give you a dividend of 1 unit between time points 1 and 2. So between time points 1 and 2, there is actually a dividend of 1 unit that goes up. And again, rate of interest is assumed to be 0. Now, we want to go through the same kind of calculations, calculating V and Y at each node, and to check whether V is better than Y everywhere. Let us look at the terminals first. So at time point 2, at the terminals, after the dividend has been paid, the payoff from the option contract will be 4. It is 9 minus 4 minus 1. The dividend goes out. So it is 4 for Y, for V, and for Z, of course. Similarly, in these nodes also, because it's the terminal time point, I have the same payoffs from the European and the American, because they are behaving the similar way now. The changes can happen at time 1. Now in the upper node, time 1, the dividend is not paid yet. The stock price has gone up to 8. So the Y1 payoff is 4 units. But if you calculate the expected value of the European here, it is still 3. It is the average of 4 and 1. It is still 3. So if I exercise the American right now, I can gain. So this is a node where early exercise is profitable. If I hold on to it, I can expect to get 3. But if I exercise it right now, I can get 4. So obviously, I will exercise it right now. In the down node, there is no difference. They are the same. So the option holder will hold on to the option. But because the up node gives you a better choice, today the day 0 price of the American option will also be strictly more than the European option, because I stands to strictly gain in one of the nodes. The price is actually 1.25 rather than 1. So this is how the option calculations work. So is that clear? Is this calculation clear? Because I introduced a dividend basically to create a difference between the American and the European. Is it okay?
Yes, sir.
So now you can obviously look at more realistic calculations, going to this web page and playing around with the parameters here. It would be a good practice because this is how the real life applications look like. Okay, so great. So let me come here where I can say that, so this is the result. You can check this result is true for all possibilities, that if there is no interest rate, there is no dividend and a fixed rate of interest, then American and European call will have the same price. So this no dividend is crucial. Okay. So if there is no dividend and a fixed rate of interest, then American option will not be exercised early. So it will behave exactly like an European option, and hence the price will also be the same. But if you introduce dividends, then we have already seen an example where the American option is more expensive than the European option. This is clear? And I will suggest that you do some of these playing around here on this website to get a better idea of the calculation steps and how it works out, particularly for Americans. European is easy because it only depends on the terminal node. But American is really, really interesting because it is path dependent. Okay. So what is the general principle that we have used? I have already told you the general principle that we always start from the terminal node and then slowly work backwards. So let me now just make it a theoretically complete statement. So what is the statement? So to make that statement, I have to introduce one more object. So I will introduce something called a super martingale. So what is a super martingale? It's an adapted stochastic process like a martingale. Only now the conditional expectation of this process is less than or equal to the current value. For a martingale, this was equal. For a super martingale, it is less than equal. So conditional expectation of the future is at most equal to the current value, but it can also be less than the current value. So is the definition clear? Is the definition of super martingale clear? Because again, I am being informal, but this is the basic idea. Okay. And another important concept that we use here is the stopping time. So how many of you have looked up the stochastic process chapters and have learned about stopping time already? Because I asked you to look up, I think, Wellport Stone or Ross for some stochastic process brush up. Have you done that yet? So now, what is the meaning of silence? What is the default? So has anyone looked up the stochastic process chapters that I asked you to? In particular, I asked you to read up reflection principle and distribution of the maximum, things like that. Anyone?
I went to Pliska and saw their calculation for this, for example.
You went to Pliska and saw this example, that I have understood. But did you look up the stochastic process textbook? Because Pliska is not a stochastic process
Yeah,
textbook.
Sir, we had
we
this
had the course,
things
so we
in
learned in
BStat second year and so. Like reflection principles we learned in while we were going through random walks.
Correct. That's where you
And stopping times were taught to us when we learned stochastic process.
Okay.
The formal definitions.
Okay.
I don't know about the NB stream guys, but
So the
for
NB
the B stream guys it was taught.
you told me that you did not have a stochastic process course earlier. So how many of you are going through the stochastic process material now? Because that will be important. We are not being very formal, but we will be using the concepts. So a book like Ross would be very, very helpful. Well, so it is very, very silent. So again, I can only ask you to do it. If you don't do it, I cannot force. But if you don't do it, then there will be problems understanding the things that are going to come later on. So once again, do go through the stochastic process material. So I have given you a lot of references. The OpenCourseware, the MIT OpenCourseware has some lectures. The Ross textbook is a fantastic book. Wellport Stone is also a very nice book. Pick up anyone, but do go through. Okay, all right. So stopping time again. So I will be giving an informal definition, but if you are reading up the textbooks, you will get a better version of it. But this is good enough for our purpose. So what is stopping time? The stopping time is an integer valued random variable, tau, such that the occurrence of each event, this tau equal to t, for each t up to t, capital T, is ft adapted. Which means to understand the probability distribution of tau or calculate the probability of tau equal to t, I need information only up to time small t. So I do not need to look into the future. Whatever information is available to me up to the time t is sufficient to calculate such probabilities. Because a random variable is completely described by its probability distribution. And that probability distribution I can find out if I have information up to time small t. Okay, is this clear? Is the definition clear? Because some of you are probably hearing this definition for the first time. So does it make sense? Okay, so let me also talk about this example that might help matters, because I don't know whether you are able to follow. So suppose my stock price is 10 at time 0, and I define a stopping time tau 1 to be the first time it crosses 20. So this is the first time it crosses 20, and another stopping time tau 2, candidate stopping time, which is the last time it crosses 20. Now you see, tau 1 is a valid stopping time because you can calculate its probability distribution with information up to time small t, because the first time it's processed 20. So whether it has or has not up to time t is all that matters. But tau 2 is not a valid stopping time because I'm talking about the maximum. So it may happen again later on, and later on is not yet known to me. So I will not be able to calculate the probabilities for tau 2 with information only up to time t. So this is a basic difference and basic criterion for a stopping time or a stopping time distribution, that it must be computable with information up to time t. So why do I need it? For American options, I need the early exercise choices. So at each of the earlier time points before expiry, I need to decide whether I should exercise the option right now or wait till the next period. So all these possible exercise choices are stopping times where I can use my option. So that is why I define a stopping time, and in the calculation steps, we will be using that. Okay. So how does it go? So let us define xi(st) to be a set of stopping times that take values between s and t. So it's stopping times in an interval, in a finite interval. Between time s and time t, the set of stopping times. This we have to evaluate. We have a risk neutral probability capital Q, and we have the adapted stochastic process Z, which is like Zt at each time point. How is it evaluated? Zt is taken as the maximum of this expectation, and the maximum is calculated over all the stopping times from today up to the expiry time. T is the expiry date and small t is the time today. So today I calculate Zt as the maximum of this expectation, and this expectation is nothing but a time discounted value of y tau. So y tau evaluated at time t. That is all that is here. So if you look at y tau, what I am doing is I am dividing it. If I divide it by b tau, the bank rates are b, then I get the value for time 0. And then I multiply it by bt. So it is like putting that money in the bank for t periods. So this is the value for yt. Value for yt, sorry, value for y tau, but calculated as if on time t. Is this clear? It's a slightly convoluted way of writing it, but because we are doing the accounting at time t, all calculations must be done as on time t. So even if the value will happen later at time tau, I want its current value. So the current value is calculated like this. Is this clear?
Yes.
So what are we doing? Zt is the maximum possible of that expected current value. And the maximum is evaluated over all the stopping times between now and the last year. Now, if you look at the range of the maximum here, the range is actually shrinking with t. So, if I do this maximization for time points t going further and further to the right, closer to capital T, this will be reduced. This cannot increase. Is that okay? That this conditional expectation cannot increase as I move towards capital T? Just take a look at it carefully and make sure that you have understood what is going on. So I'm defining this adopted process Zt by this Z by defining Zt equal to maximum over the stopping times between now and time capital T. Expectation of a current value of y. And I am saying that if I move towards the right, if I move closer to the expiry date, this maximum can only reduce. It cannot increase because I am calculating the maximum over a smaller and smaller set. So is this clear? So is this calculation clear, or should we go over this once more? So, so can one of you respond whether you have listened to this thing so far? Can one of you respond?
Yes, sir, we are listening.
Yeah, but is this clear? So my question is this clear, or do you need a little bit more time to think about this?
We need some time, sir.
Yeah, I understood that. So please tell me that. You see, we are not in a real classroom. I cannot see your faces. So I would really love that you tell me, even if you don't understand. I don't mind you are saying that you don't understand, or I have done something unclear. But I need to know. Unless you tell me, it's very difficult for me to just blindly proceed. That's no good. Okay. All right. So let me stop here. We are currently at the point where we are trying to understand the American option pricing process, the theory of it. We will continue that on Wednesday. But once again, please go through the stochastic process basics.
Sir,
Yes.
sir, could you please tell the points that we should specifically look from that stochastic process chapter? The particular points.
Okay, so I think I already mentioned those points. So let me once again, okay, so let me show you once again. I mentioned this specific points earlier when we were discussing in chapter 3. Yeah, so it is here. Can you see this page 25?
Yes, sir.
So in particular, I wanted you to read up what is called the first passage time, the first time you get to a level, and also the distribution of the maximum value. And I said that if you need to understand these two things, you will also need to understand what is the reflection principle. Reflection principle is a very important principle, extremely useful for evaluating all sorts of stochastic process questions. So reflection principle leading to these two things would be very useful for us.
Okay.
And now I have added the stopping time definition today. So if you can also look up the stopping time definition, that would be nice.
Okay, sir. Thank you.
Okay. So, well, I will stop here today. And Wednesday, we will continue this discussion. But we need to fill up these gaps. These gaps are important to fill up.